Today, folks, did you know that 80% of all mortgages outstanding as of March 2022 are up for renewal in Canada this damn year, amounting to over $250 billion. And there was so much fear out there, and I would have loved to be a fly on the wall to listen to some of these renewals, as people were likely going from like a 1 or 2% mortgage up to a 4 or 5%, right? But the fact of the matter is we are starting to level off. The economy did not collapse, and though we're seeing some defaults and shakier loans out there, as mentioned, like, you know, some people are going to struggle with this. It's still not as bad as it was, or not even close as bad as it was to the period during the pandemic. And I'd like to reiterate how damn strong this sector truly is and why it's so largely underappreciated, and people are starting to miss the boat. I think 2025 is going to be a substantial year, and I'm going to explain to you why in this video. But firstly, look at the BMO Equal Weight Bank ETF. If you bought this 10 years ago, you were basically up 59-60%. Compared to the TSX, it's only up 52-53%. Keep in mind, the financial sector pays a way higher yield, and from 10 years ago, you were getting like 6 cents a share out of this ETF, and today you're getting over double that dividend at 14 cents. So just keep that absurd performance in mind. Like, this sector outperforms the broader TSX as a whole, right? It is a beautiful thing. So we're going to break down the two banks I did not talk about, National and Canadian Imperial Bank, that have absolutely crushed the S&P 500 this year. And then we're going to compare it to the other banking stocks now that we're on the other side of earnings. And if you're on a path to financial independence, to perhaps one day retire early, join me on that journey. Go hit that subscribe button and like this video while you're down there if you love dividends and passive income, because Canadian Imperial year to date is now up 20%. If you bought the dips, I mean, you would have seen close to a 7.5% yield, I believe, at the peak of the bottom of the stock here, and now you're up 65%. Now, again, I'm not advocating that you buy these on an individual basis, and I'm not a financial advisor. I'm a clown on the internet, so take this for what it's worth, but I love buying these like Pokemon cards. You just got to collect them all because they ebb and flow, but as a whole, they outperform. The dividend, unlike, the ZEB ETF, it hasn't doubled quite yet from 49 cents 10 years ago to 90 cents. I'm sure we'll be getting a dividend increase soon. As we take a look at their net earnings here, I want to remind you, this bank specifically, and a lot of these banks, are now starting to go over the hurdle of what is going to be the end of massive loan loss provisions, because we can see their total revenue was 6.6 billion versus 6.1 just this time last quarter, and it was 5.8 going back even a few quarters, this time last year, right? In total, basically for the 9 month, 18.9 billion versus 17.4, with loan loss provisions for the first real material time starting to go down. We're at 483 million for the quarter versus 514 for this time last quarter. We are starting to actualize the record revenue that all these banks are experiencing. All these banks are basically making better revenue than they were this time last year. And we're starting to get there, right? So we can see in the Canadian residential mortgages, we've almost doubled just from 2 quarters ago in basically, impaired loans. And this isn't great. We're at 0.3%. It is slowing down, however, from 0.26% last quarter to 0.3. It's still a pretty hefty increase, but I think we're going to start leveling off here. Time will truly tell. But across the board, if you take all of it into consideration, it is leveled off. And this is all we needed, was loan losses, quality loans, gross impaired loans. All this stuff needs to start leveling off, and we are in a brand new banking bull market. Look at National Bank. Here's another great example. Year to date of almost 24%. I mean, again, you bought the dips. You're not doing as well as Canadian Imperial, but you're still up 46%. You probably locked in closer to a 5% yield. On top of that, your dividends have gone from 46 cents to $1.10. You've over doubled your dividends with this bank. So let's take a look at how they're doing. Firstly, the payout ratios on these banks are 50% or lower for the most part, so they're highly stable, highly stable. I mean, net income was $1 billion versus $830 million this time last year, up 24%. If we take a look at those loan losses, however, and this is what's perplexing me a little bit, if we take a look for the quarter here, $149 million versus $111 million this time last year, we can see the net formation basically between personal, commercial, financial, wealth management. Outside of personal loans, which I'm curious to what those are, maybe line of credits. I'd be really curious if they relate to mortgages. It's still a pretty insignificant number. It's one of the few that's kind of leveling off from Q1, but as a total from 310 to 226 has decreased, right? So here's another bank that is proving that they can actualize some exceptional loans or exceptional growth, right? With strong growth on both sides of the balance sheet, from loans and basically deposits are both going up. I love looking at this and just taking a look at retail mortgages and reminding you as well, a huge percentage of these mortgages are insured. So they have security, and that's another thing people forgot. that, like, you know, yeah, some mortgages are going to come into default, but a lot of them are secured by insurances, and the entire housing market hasn't exactly collapsed either. So even if these, you know, loans they go impaired and these people go into bankruptcy or default, that mortgage is going to go into a forced sale. And so long as it sells out to pay the mortgage off, the banks are good. And housing hasn't exactly collapsed here in Canada, right? So as a whole, I'm collecting these Pokemon cards through VDY. And as these banks begin to perform, we're seeing VDY actually performing with the banks. It's up. You know, they make up 50% of this entire ETF. I get to own all the big banks. And now we're finally starting to see a turnaround. If we take a look at the sector as a whole with like Globe X Equal Weight Bank ETF here, this is the same as ZEB, a little different. It's up 8.49% year to date, whereas the ZEB ETF is up about 7.79. But what I find interesting is if we take a look at the sector as a whole on it, when it comes to the worst performers, Bank of Nova Scotia here, it's got a ways to go. It's only up 5% this year, but keep in mind when you've locked in probably closer to a 7% yield if you bought it on one of these dips, I mean, you're getting an exceptional return if it stays level here, right? BMO got absolutely slaughtered because I think they had a huge, you know, company that they were loaning to, some commercial company that actually went into default. They're going into bankruptcy, and they had to put a pretty large, basically loan loss provision aside for it that really impaired their income this quarter. But something tells me, you know, this is going to be temporary just as much as it is with TD. TD, if it wasn't for them having to put aside extra money because they're going to get fined for that money laundering, has a lot to do with drugs and all these other issues, which is very interesting. It's the second largest fine to ever be issued to a U.S. bank. I still think, you know, come next quarter or the quarter after, considering loan losses are leveling off for them, considering they're hitting record revenue all the time, that this is still a buying opportunity of a lifetime. And I always remind you guys, like, you take a look at TD. If you take a look at their dividend yield on macro trends, I want to remind you that these were opportunities of a lifetime. They have never happened in the entire history of the Canadian financial institutions. If you take a look here, you know, in the entire history of TD, their dividend has never been this high. And that has been the same for all these banks. Like, I mean, if you bought the dips on a Canadian Imperial here, I want you to just remind yourself that these are world-renowned banks. You could have locked in, like most people would be happy with a 7 or 8% return. And that's what the yields were on these banks just, you know, a year ago. So, you know, the time to make real money on these is starting to pass. And I told you guys this time and time again, you need to be paying attention, right? Royal Bank was another great buying opportunity. That time has come and gone now. It's at an all-time high. So, you know, I'm just pointing it out. National Bank and EQ Bank and some of the smaller banks have even performed much better than the larger banks. I mean, EQ Bank is still up 11% this year. Now, these, of course, are just opinions of my own, but I will pass the question off to you. What do you guys think about the Canadian financial sector? What did you think of the earnings in totality here? I am becoming more bullish than I ever have been, and I'll keep cost averaging into it through VDY, because presuming the banks continue to outperform, so will VDY. But I'd love to know what you think in that comment section below.